When I saw this question, it's kind of like asking you which one of your children do you love the most. I mean,
Yeah.
it's a tough
Yeah.
question to answer, but I think you benefited in multiple ways, and I think both ways, whether it's the loss ratio or the expense ratio, you got the ability to benefit from that. So if I look at the loss ratio and the ability to out-select the market or to become more refined at that, just based on different data sources, we've looked at different variables that help drive, or at least we know drive, certain elements within the portfolio that we can better refine and kick those deals out before they even get to the underwriter's desk. So that helps from an efficiency standpoint, because the underwriters are then able to then work on those that they know are most profitable to the organization, but also we can then increase the throughput of those underwriters. So this is where it gets the expense ratio piece of it. So we could do more with less underwriters. And it's not to say that we're just going to, because I think everyone envisions these stacks of paper that are now going to hit the underwriter's desk of more submissions they need to work on with the same underwriting staff. It's getting more efficient in terms of what they're actually focusing on. And if I look at just an underwriter's day today, the amount of time they spent entering data into the pricing models, entering data into our modeling systems, entering information into whatever other different system that may be downstream that has to be fed, there's just a lot of wasted time. And so we've worked with some companies to explore the ability to then streamline that process. So the underwriters are now just focused on the pure underwriting of the risk, which is really what we're paying them to do. And the whole back end piece of it is being taken care of through automation. So they can just go in, evaluate the risk, bind, negotiate with the broker as needed, or in some of our less complex business, like our homeowners and some of our small commercial, that can be done on a straight through processing or through an online platform where we kind of take that underwriter piece out of it. So I think it's really moving the underwriters further upstream on the risk evaluation piece, and not necessarily saying that we're just going to wholesale get rid of underwriters. I think it's just reorienting to where we need to push them further up into the value chain. So it kind of gets at both. It helps you on your loss ratio, focus on the business that's most profitable, and then you have more throughput that you're able to push through the underwriters. And we've seen success with that already.